Welcome to episode 28 of Accessible Finance, where we demystify personal financial topics and answer your questions so you leave saying, I get it now. I'm Eric Johns.
And I'm Rachel John.
Let's dive in.
All right, Eric, we are officially in mid-March. And so the majority, if not all of our clients, are in the process of tax prep.
Yeah.
Yeah.
And assessing the competence of their CPA,
Correct.
typically incorrectly.
Fair. So I would say that the majority of our clients that we've been looking at planning, tax planning for the year with have told us either we're expecting this refund. We usually use it for vacation or something like that. Like our clients know if they usually get a refund and exactly what they're planning to use those dollars for.
Sure.
And so you've been pushing back a little bit there. Why?
Right. Well, to be fair, it's typically not our clients. Like we can tell them within.
Not our ongoing clients, but our onboarding clients. Like we're
Correct.
onboarding clients right
Sure.
now
Yes.
who
That
around
said,
tax time are
right.
telling us like, "Oh, I'm going to get this refund."
Right.
Yeah,
So my refund has changed from last year. It's either
correct.
higher or lower.
Correct.
Does that mean that, my
Maybe
taxes were,
not.
my tax preparer did a great job
Right.
last year because I got a $2,000 refund, but this year I got $1,000.
Correct.
Did they
What
mess
did
up?
they mess up? Yeah, exactly.
Right. Like what changed and why are they bad at their job?
Correct.
So the first thing to say is that is not the parameter for success. Okay. Why? Because the tax refund just indicates the amount that you've already paid or really just the amount that you've already paid to the IRS relative to your tax liability.
So you're telling me that if I get a big refund versus if I don't get a big refund has nothing to do with the skill of my accountant.
Correct. The only thing that would indicate skill is that if they haven't asked you, if you owe a large amount of taxes at the end, which means you're going to likely pay penalties and interest, if there's a huge underpayment penalty, and again, this is not always the case, so it depends on the answer that everybody loves. But if there is a huge payment owed that's going to generate penalties and interest, that's problematic for your tax
Sure.
preparer. But even if you owe some money, that could be good. You could be borrowing money essentially from the government and then pay some back at the end, and you're in a safe harbor zone. We're pretty happy about that.
And
like
we're
that.
going to elaborate on what that means.
Yeah, we can talk about that.
The majority of people, when they're working with a CPA, underestimate how much of it is simple data entry and
Right.
overestimate how much of it is wizardry. Right?
You're absolutely right.
Like if you're working with an accountant that really knows their stuff, they may know that if you're a teacher, for example, there's an educator expense that's there. Is it going to make or break anything?
Nope.
No.
$300.
And so there are little things typically that a very knowledgeable CPA can do to
Right.
say, oh, hey, you have kids. Like, what kind of expenses do you have for the Louisiana tax return that can help
Right.
with, school expenses? But overall,
there's a lot of just writing down.
You're going to owe X
entries.
amount.
Right.
Did you pay it through your paycheck yet or not?
Correct. So we're going to talk about a couple today that we're going to say they earned about $400,000 gross income, right? And they got a $30,000 tax refund.
So you'd think that their CPA is an absolute wizard.
Right. They come to us and they're elated.
Yeah.
They tell us, wow, our CPA is fantastic. He gets us $30,000 refund.
Every year.
And we say, he's actually, or he or she is actually
Thank you.
suboptimal. He's actually not optimizing your tax situation. And they're like, what do you mean we have huge refunds? Clearly he's doing something right.
We get to take a vacation every year.
Correct. But if you look at their tax liability, right? He could be doing there could be no change there. Maybe their tax liability, let's call it, let's say they owe $100,000 a year. Let's just round up. They owe $100,000 a year, right? And they're withholding $130,000 a year. That's where the $30,000 refund came in. So what did they actually do? They made a $30,000 interest-free loan to the federal government. Okay,
who wouldn't want to do that?
Yeah, who doesn't want to Uncle Sam money for free, right? T-bills right now are paying 5.25%.
Okay.
So we're going to round down to 5. Assume a 5% return, $30,000.
Yeah.
What would that get you? That's $1,500 of interest income a year.
So you're telling me, all right, so let me see if I can understand this. So option A, which is what this couple has been doing, they're withholding 130 instead of the 100. Right. Shockingly, their HR department doesn't care at all. So they're just like, we'll withhold.
HR doesn't even look at that.
Correct.
You turn them in a W-4 and they put it in a system. That's it.
Correct.
That's
where CPA, I would say that on average, the majority of people interact with their CPA once a year when they go and hand them the papers.
Correct.
So the CPA is probably not doing much in the way of active tax planning for the client.
Correct.
Throughout the year. there may be an argument that if there's like estimated tax payments or you're self-employed, that there may be more stuff involved. But on average, especially if you're a W-2 person, you just show up, you hand them your papers, they put it in, and you're there.
Correct.
So option A, they're withholding 130,000. Government says, oh, we only needed 100. So after a year of holding on to your 30, we're going to be back 30. Okay. Option B, you're saying, okay, change your withholdings, withhold the 100. So you're there. You get no refund, but take that extra 30 that you've been holding, put it into a T-bill. And then at the end of the year, you end up with 3,000 or 30,000 or 31,500. Wow,
that's
that
correct.
was hard for me.
That's correct. And to be clear, we're rounding. We're making the numbers round. I understand that you would not get the $30,000 on January 1, right?
Sure.
So the withhold, you know what I mean? The withholdings are throughout the year. We're just not worried about that granularity right now.
I think that it's important to understand that the money that is being withheld and basically put in a safe for the government that is then afterwards been like given back to you, as interest rates are continuing to climb or move or be
or staying the same at a reasonably high level, which is where we are.
Nothing's happening for your dollars. Correct. So they just sit there and then you get your $30,000 back at the end.
Exactly. And in a lot of cases, it's actually advantageous to owe some taxes, right? What does that mean? That means these are high income earners, so they need to withhold 90% of the current year's tax liability, right? So they would need to withhold, in this case, if we said it was 100,000, they need to withhold $90,000 in taxes.
Now, to be clear, it's not because they're a high earner that they need to withhold the 90%.
No, 90% is a safe harbor that applies to everyone. 90% of current year tax liability, or if you make over $150,000, then you have to withhold 110% of last year's tax liability. If you make under $150,000, you need to withhold 100% of last year's tax liability.
Now, these are the things that the CPA can and should be knowledgeable about to make sure you at least don't like step in it.
Yes.
So there's at least that. So we want to make sure that if we are working with a client like this, that we're advising them so that they're withholding enough to not be in trouble, right? But not so much that they're basically loaning the government money for free.
Correct. There are actually situations where you can alter your withholdings to withhold almost nothing in the beginning of the year. And then if maybe you have some huge expenses you need to cover, and it's just a cash flow issue. To be clear, we're not saying like you borrow this money and hope that you just miraculously come up with it in time. But if you can absolutely understand that you're going to get it before the end of the year, you can under withhold on the beginning of the year and then withhold basically your entire paychecks in like November, December if you want to. That counts.
We've absolutely done that with clients. And I think, sometimes when there are annual expenses that are front loaded, for example, you've got your homeowner stuff that typically comes around January. Sometimes you have to put down, a year's worth of tuition for kids, things like that. So if you know that there's an expense that's going to be hard hitting initially, but that you're going to be able to supplement and replenish that bank account with your W-2, you can just turn up those withholdings later.
Right. So if we're trying to answer the question, how amazing is my CPA?
Yeah.
How do we do that then, Eric and Rachel? Do we just look at our tax liability and if it's lower, it's better? No. Unfortunately, that's not great. So we've actually seen this too. There are people that want to zero out their tax liability.
Yes,
they want to owe nothing. Some people would even zero out their tax liability and not use the full amount of their standard deduction. And you guys are like, I've heard a lot of these words before. I have no idea what you're saying. What we're saying is you typically want to fill up the lower tax brackets. What does fill up mean? That means I want to pay taxes I want to try to realize income in those brackets, right? So that I fill them.
Mm-hmm.
All right. So like I want to, if I'm single, right? And there's the bottom bracket is from 0 to 11,600. If my income is 0, I want to try to realize $11,600 of additional income. How do I do that?
Yes. But the reason we want to, just to be very, very clear, is because if I make $0 that I report, or if I make $11,600, if it's $11,599 that I report, I owe the same amount of taxes on that.
No.
Yeah, it's in the same bracket.
No, this is the 10% bracket, right? So you're paying 10% on anything from 0 to 11.6.
Well, 11,599.
Okay, sure.
Yeah, that's what I'm saying. So like that entire bracket is at the same percentage.
Got it.
Right?
Okay, sure.
No, I'm not saying that like if you make $0 or you make like $10,000 that you owe $0.
Gotcha.
It's in the same bracket.
Apologize.
Thank you. I wasn't clear though. But yes, if you make any amount of those dollars in that bracket, you're going to be taxed at the lowest bracket possible.
Right. We
I
want to
think the
pay taxes
majority
when
of
we're at about 10. We want to pay taxes at 12.
correct.
We want
Well,
to pay taxes at 22
and I think
sometimes.
some of what the challenge becomes is that some people, I think, truly believe that if they get away with paying no taxes now, like or less taxes now, that they'll be able to continue getting away with paying less taxes. But
Right.
unfortunately, the systems are set up with the government where they will force they were going to force artificially high income reports on your tax return eventually. They're not going to let you get away with not paying.
Right. So what we said in the past is we want to level off the
Yeah.
tax rate that we're paying over time. We don't want it to go to zero. We pay 0%. And then we go and pay 37%, right? Or 35 or 32 or even 28. We don't want that huge jump.
Yeah.
We want a flat line. I mean, it'd be great if it's around 12%, but
That'd
even
be
around like
ideal.
22 is pretty good. So how do you artificially realize income? You can do things that we've talked about in the past, like Roth conversions, like distributions from your retirement accounts, which are like 401ks, traditional IRAs, right? So you can increase your income. You can bump it up. So there are times even like we just discussed, Roth conversions and distributions from retirement accounts, where you are artificially increasing your income. Well, maybe not even artificially, but you're increasing your income, and and therefore increasing your tax liability. So it can be a good thing to pay more taxes.
Yeah.
So you can't not only can you not look at the magnitude or direction of your refund, you also can't really look at the tax liability as as an indicator of success or failure for your tax planning strategies, which is unfortunate. So,
right. I mean, I think the number one thing is that if what you're paying is something that you proactively had a hand in, that's a good sign. You've partook in where you are.
right.
You never want to be
Yeah, that is
reactionary
a very
to.
good point.
Thank
That is
you.
a very good point. You want to be intentional
Yes.
and deliberate about what you're doing and how much you're owing.
Yeah.
And also, we would say it should never surprise you. The magnitude,
Correct.
neither the magnitude nor the direction of what you're going to pay or receive from the federal government or state government should surprise you. You can plan these things out.
Correct.
January 1, like
Yeah.
October, you can look
Yes.
at it throughout the year. You should be making adjustments or
Correct.
I don't want to say should. I don't want to shame. We're not shaming anybody, but you can.
Well, it
You're
doesn't even
permitted
need
to
to
make
be
adjustments
correct.
to your W-4 throughout the year.
Correct.
I can adjust my W-4 every month, every week if I really wanted to.
Go down to HR, make friends.
It's their job,
Yeah.
right? They have to do it. They can't tell me no.
Correct.
So you can adjust your withholdings periodically if you're like, oh, wait. I realized I just ran my numbers again. I'm going to make extra money from my side hustle or whatever. Now I need to withhold a lot more, and now I have self-employment income.
And so I really think that the metric for how effective a professional that you're working with is, if they're looking to be proactive in tax planning, is how adequate or how accurately they're really predicting your end scenario to be,
Yeah.
and then what the end scenario actually is.
Correct.
So the refund would not be the metric for success.
Mm-mm.
The magnitude of said refund would not be the metric for success, because yet again, like if I'm telling you to withhold a certain amount of money and then at the end you get $30,000 back, I was off by $30,000.
Yeah.
So if anything, that suggests
not
that
great.
right.
I would argue that the CPA that has done your planning, right? Or I'm sorry, it doesn't even have to be a
I
CPA.
was going to say
It
they
also
may
be an
not
enrolled agent
teach.
or any
Yeah.
tax preparer.
Yeah.
Okay. And we're not here to plug anything, right? It's
Sure.
just a tax preparer. The success or failure of the tax preparer can be, viewed by how well. I would say that the one who made you owe $0, who left you owing zero tax liability, zero refund, is better, objectively better than the one that had you receiving $30,000.
If
And so
it
this
was
is another-
intentional.
Correct. Yeah,
I
sure.
mean,
Right.
I think that there's very much a misconception that like there are these weird secret loopholes that
Right.
CPAs have access and
There
knowledge
really,
to.
guys, there aren't.
And the thing is, now more than ever, the accessibility to the general public of what those are is right in front of your face. I mean, the software that's out there that's free or very cheap to file your own taxes, it literally walks you through and says, hey, you might not know this, but if you have these things, there's like it's almost foolproof to be able to file your own taxes at this point. So there's
we'll
no
plug
magic wand.
freetaxusa.com.
Yeah,
freetaxusa.com. We're not paid,
excellent.
affiliated, whatever, but
Correct.
yeah, the
Use
website's
it.
pretty functional.
Yes.
Seems useful.
And so it really will guide you through that. So more than anything, the expertise that you should be paying for when you're talking to somebody for tax planning is the ability to really hone in on and regularly adjust throughout the year to make sure that your end scenario is exactly what you need to meet your goal.
Correct. And so some of the pushback we get is, but guys, we like this return.
Yeah.
We plan on this. I'm sorry, I said
The
return.
refund.
We like the
Yeah.
refund that we get
Right.
when we submit our return
We have
because we
these
plan on
30,000 in the
vacations and
back.
we
Yeah.
know now that we got money coming in.
Mhm.
We would advocate, look, a separate savings account.
Yeah.
Siphon off from your paycheck that if you were going to save an extra $400 a month or $1,000 a month, take that money and siphon it off into a separate savings account that you guys aren't looking at regularly. It's not hitting your
Yeah.
checking. You don't view yourself as having these
Yeah.
artificially inflated balances that we're
Correct.
going to go spend.
It does require some self-discipline there.
Right.
However, you can turn the 30,000 into something that's greater than 30,000.
Exactly. Right. And then when you're going in for your vacation, you get an
Yeah.
extra $1,500.
Correct. You might be able to get some meal plan at Disney.
Or a new snowboard and bindings and boots. 1,500 will work.
Someone may or may not meet exactly those things.
Let's do it.
It's convenient.
Yeah.
But our Disney trip is first, so.
Unfortunate reality that I live in.
But yes, I think that it's just to be able to kind of demystify, what this role is of an accountant. It's no longer, being the expert in what kinds of deductions there are because the software literally asks you for it. It'll say like
so 90% of people are taking standard deductions.
Correct.
Right. And by 90, I mean like 98. It's very high.
Yes. I mean, the amount of time that we used to spend going through and putting together a spreadsheet with our own itemized deduction stuff, only to realize that it was still never, well, I mean, at one point it did, but still very rarely, and certainly hasn't recently, met the standard deduction amount.
Right.
It just became a waste of time. And so the software now makes that really hard to miss deductions and things that you can do that will minorly change your return. It really comes down to the withholdings from your paycheck.
Correct. If you do not have a business that you're an active participant in, or even passive, just forget if you're involved in a business. But if you're a W-2 employee, okay, what should you be thinking about? You should be thinking about childcare receipts mostly, right? Because both in Louisiana and federally, they will let you deduct things like that. Okay, so you can do things like tuition, books, uniforms for Louisiana return, child and dependent care expenses. So if you're paying for anything so that you can work, right,
summer camp, aftercare,
you can receive 20% of that as a credit,
yeah,
capped at $3,000 per child and $6,000 total. So the cap on the credit
again, if you are filing your own taxes, the software that we mentioned, the Free Tax USA, will say like, hey, do you have kids? And if you say yes, they'll say, what did you spend on childcare? Like it will not let you
there's a lot of handholding going on.
Yeah, it won't let you miss that. So what you're paying for when you're paying to work with an accountant, an enrolled agent, a tax planner, is more than data entry because that's something you can do. Right. So if all you have is somebody who's putting in the data.
Right. Could they miss that and you missed your $1,200 maximum deduction on child dependent care? Yes. And they could, but you would have no indication of that by looking at your refund.
Correct.
Does that make sense?
Correct.
If I withhold an extra $1,200, then I'm going to get it back regardless of whether or not I'm getting this tax credit.
You would only know if you decided to go and look at all the worksheets on your tax return and knew what you were looking for.
Right.
So
you have no idea. So
correct.
I guess the bottom line is that neither the direction nor the magnitude of the refund or taxes owed or payment owed at the time of filing is any indication of success or failure of the CPA.
Right.
Right?
Fair? Or your enrolled agent
the bottom
or whatever.
line. Oh, sorry, tax preparer. Yes.
Yeah, exactly. And so I think sometimes when you're working with a CPA, there's more so now than previously, because the information is so readily available, there is a misconception that they are doing tax planning. And I think it's really important to distinguish between
tax
preparation and tax planning. Tax preparation is, you gave me your papers, I put it in, here's your tax return, great.
Yeah, thank you for your W-2 and thank you for your 1099s.
If you haven't had conversations.
And I data entered into my software and it spit out this result.
Which is also something that you could do.
You could also do it with freetaxusa.com.
So if you haven't had conversations with them about, what your plan is or what expenses are throughout the year, if you're not actually having conversations with them meaningfully
about your long-term tax planning strategy, then
they're not doing tax planning for you.
Correct.
That's not what you're paying for.
Most honestly aren't going to be unless you're paying them hourly or on some kind of you've worked with them on an ongoing basis. They're typically not going to be talking to you about like what your current bracket is,
Correct.
what your
Well, exactly. So like
how
Eric,
much you're contributing to retirement accounts and that kind of
what
thing.
are some of the like questions or conversations that you would have if you're having tax planning conversation? Just so that, because I might think like, okay, my CPA here. Oh my God.
Yes. I dropped my pen
I
and I
can't.
couldn't twirl it. And it just,
It drives
sorry
me
guys.
crazy. But so what are some of the conversations? Like you might say, like, okay, when I go into my CPA's office, yeah, I hand him papers, but we talk like that he wants to know about, she wants to know about my situation. So how do I know if I'm paying for tax preparation or tax planning? Like
Right.
what do those conversations look like that are very different?
Sure. And I mean that's a very good question. So you would want to ask them things like, should I be contributing to a traditional or a Roth IRA now and or later, and why? Like,
Mhm.
what does my long-term tax planning strategy look like? That's going to involve things like, when am I thinking I'm going to retire?
Correct.
If you're doing things like retiring early, that would change your complexion pretty dramatically
Yeah.
of the planning, right? So you need to have less assets tied up. You might want more in a 401k
Mhm.
because you can access that at 55 versus 59 and a half.
Like,
There are
yeah,
huge amounts of conversations to
implications.
be had around all of these planning strategies.
So there could be
Um,
projections beyond this year. Like you should be talking more than this bubble of the year.
Absolutely. You should be looking at really, you want to look at lifetime. And
Yeah.
yes, the plans are going to be like you're going to make the plans and they're going to differ slightly at least in from what you've written down on the paper, but
Mhm.
you should at least have a pretty good idea of where you're going and where you are and where you're going, right? If you need to be headed directionally in the correct
Mhm.
direct, in the correct way.
Now, this is one of the reasons that we, as like our firm, and what we would advocate for clients or just the general public, is to work with if you're working with financial planner, to work with one that is eager to and willing to meet with you and the other professionals to make sure that everyone's on the same page, because you may not know or feel comfortable having those really specific, very
Mhm.
granular, very technical conversations with the CPA. Um, and so your planner, who should have already had those conversations with you, can help really discuss with them what the plan is, what you're looking at
Right.
moving forward,
There's also a
and so on.
tremendous amount of variance in financial advisors or financial planners
That's understandable.
offering,
The
yeah, oh
central.
boy. But let's avoid that soapbox for a second. But there's a variance in whether or not they'll even offer tax advice or even tax, planning because they don't want to step on, some toes and be considered tax advice, and now they're
Yeah,
liable for having issued, or given tax advice without,
correct.
a designation that enables them to do so. And insurance is going to pay the liability when, you say that they should have known
They
better.
they told me
Right. So
to.
anyway, there's a difference in whether or not they'll even do that. So it benefits you to have a conversation with somebody that's willing to make those kinds of recommendations. Okay. So
Correct.
give tax advice or do meaningful tax planning. That's at least you just want to feel comfortable that your situation is being addressed. You're
Yeah,
planning for now and for later. And
and
you
for
want to kind of
later is a
know,
big part.
yeah, you
Yeah,
want to have a pretty good idea
right.
of what you're going to do over time.
So you just don't wanna find out in 20 years that you wish you would have paid more taxes 20 years ago so that you're not paying in the 40% tax
Right.
bracket now or whatever
I
it
would
is.
say find out the why. So if we're going to get a $30,000 refund, find out why. What
Correct.
happened to do this?
Right,
Why are we getting this refund? Did we need to? Could
right.
we have, we
It's
withheld
a
less?
hard conversation to have because when you find out, especially if you're not expecting it, if you find out you're getting
Yeah.
$30,000, you
You're
don't
like a
wanna
kid at
be upset.
Christmas.
Yeah,
You're
you don't
excited.
need to be upset with your
You're
CPA.
ready for the new bindings.
And so we're
It's
not
simple,
saying exactly. We're not saying that you should be upset, but you should make steps moving into the next year to make sure that that doesn't happen again.
unless
That's
you
not
wanted
to
to,
say, well,
but you shouldn't.
right. Our advocacy is not to want that.
Correct.
That's not to say that you don't want 30,000 extra dollars, but you want to be in control of this 30,000 extra
Right.
dollars.
Right.
The
That's the
taxpayer
thing.
doesn't care about investing it wisely
That's the
for
thing. The
you.
magnitude or the magnitude and direction of the refund
Yeah.
or taxes owed at the time of filing has nothing to do with your tax liability
Right.
and everything to do with how much you've already paid in.
Mhm.
So it's just about your W-4. And a
Right.
W-4, just to be clear, is the form you fill out to elect how much you want withheld
From your
from your paychecks. Yeah, I'm sorry. Going straight to the federal government.
since you don't have the right pen.
I know it's unfortunate. It's blue. My personal's black. But anyway, thank you guys for this discussion.
Yes.
One more time, bottom line, neither the magnitude nor the direction of
Yeah.
the tax refund or taxes owed, right?
Mhm.
Or payment owed at the time of filing is indicative of the competency of your tax preparer.
Correct.
Okay.
Correct.
Actually, I would argue that if the magnitude's super high of your refund, then they probably should take a
It's
closer look.
really
So they might be suboptimal at their
exactly.
jobs.
If anything, it's Right. Great. So in addition to like scenarios or questions that we have coming in, we certainly welcome questions specifically related to, you know, refunds and tax stuff as well, just to talk hypothetically about what kind of implications.
Yeah, if you want to give us some round numbers and ask a question or two, hit us with it.
Yeah,
let's
for
go.
Sure.
Alrighty, guys. If you enjoyed today's episode, please follow and review the show. And if you have any topics you'd like discussed or financial problems you would like solved, reach out to us, podcast at equilibriumft.com, or visit the website, equilibriumft.com.
Till next time.
Thanks, guys.